Our next panel, a view from the top. Several presidents and CEOs of management companies, brands. We do have a fill-in on this. Thank you, Eric Jacobs, I'm sure. Unfortunately, Liam Brown was weather delayed coming out of Bethesda, as I know a lot of people were. But at this point in time, I'd like to welcome Kurt Kinsell and his panel to the stage.
Thank you. We'll see you later. Okay. Well, good morning, everyone. Happy Thursday, and welcome to the second session of second day of Hunter Conference. Congratulations to Bob and the family and Georgia State on the 30th anniversary of the Hunter Conference. It's a great, it's been a great ride, and it's been meaningful, particularly for the limited service, select service, but for the industry overall. So let's give Bob a round of applause for that. We've got a great panel here this morning, and four gentlemen who have joined me. I know you've read about them or can read about them. However, we've had a couple of changes as well, so I just want to take a brief moment with that. But I've got Ken Green with Radisson Hotels next to me here. And next to Ken is Eric Jacobs. Eric has joined us as Lee said, Liam got stuck in the weather. I guess you got out, but he didn't, so it shows.
We canceled flights and a 2-hour on the airstrip trying to get here, so yeah, it was
good for you. You know, a development guy knows how to get into the
We had
seat.
one guy dog sled it down. So.
Yeah, there we go. But Eric is Chief Development Officer for Select Service Brands at Marriott, so thank you, Eric, for stepping in.
Yeah.
Dave Johnson, I think many of you know Dave at Aimbridge, and Ken Vecchione is joining us. Robert Sarver was printed in the program, but Robert's stepping up into the chairman's office, and Ken is stepping up into the CEO office April 1st. So congratulations, Ken, and thank you for joining us. So and welcome to the Hunter Conference. Yeah. I'm not sure you all had an opportunity to see or to hear from the first group this morning, both Mark and Jan and Kate. But you know, they gave a great overview of what's going on in the industry in the economy. So whether or not you had a chance to see it, I am interested, and I think the group out here is interested in how you prospectively see 2018. Both from an economy standpoint, what maybe some of the headwinds might be, or opportunities, and more specifically, maybe the lodging industry. So, Ken, if I can ask you to kind of kick that off.
Yeah, no, we look at 2018 as being a really robust year. We don't have a lot of concerns about 18. I think, I mean, we always hear about the nice economic run that we've had, and everybody's looking over their shoulders and when that's going to stop, but I don't think that's in 18. We're seeing a lot of development growth in major marketplaces, particularly in the upper upscale market, and that's really encouraging. Of course, that can all come to a stop but at any given time, but right now it seems real robust, and we're real excited about 2018.
Good. Eric?
I mean, I think we're in a really, really good spot right now. We'll open a record number of hotels this year. We think you know, obviously GDP still in the mid-2s. RevPAR, as reported this morning, still think it's going to be mid-high 2s in terms of growth. That will continue to spur interest in terms of new development. First quarter of this year, we're even ahead of pace in terms of approvals of last year. So what does that say? It says those of you out in the investment development community still see it, you know, the hotel business is a viable way to invest and grow. You know, as long as that supply demand continues to kind of stay in balance, we're pretty bullish for the next couple of years.
Good. And sorry if the audience didn't hear a little bit of your first portion of your comments, but I'm sure those in front did. But it sounds like we had a little microphone issue.
Sorry.
It's cured now.
Good.
And Dave, from a management platform standpoint.
Yeah, Kurt, I think, you know, a couple of things. I think, you know, 14, 15, 16, we were all spoiled with, you know, 4 to 7% RevPAR growth. So I think once we hit, 16 and into 17, we were in the 2 to 3 range, as Eric said, and I think we were kind of like a little gloom and doom and pessimistic, but I think everybody's gotten used to this new normal. We compare ourselves to industries like retail and some others. I think 2 to 3% top line growth looks pretty good. I'm also pretty bullish on, the tax cut. This repatriation of all this capital that's going to come back from where it was parked overseas, and the other thing is this infrastructure. If we can get the government to get this infrastructure bill passed, I just think it's going to be, I don't think we've seen the extent of the tax cuts yet. I think there's some very positive momentum that will continue to happen, and we'll get corporations to continue to invest because there's record amounts of capital on their balance sheets. And, I think they're feeling pretty good about investing that into growth, which is obviously good for our industry.
Yeah. And now, Ken, we heard from Robert last year. He was a new player to this audience, and so the audience may not know a lot about Western Alliance. So feel free to also talk a bit about your bank and yet where the bank sees outlook.
Well, it's great to be here. This is my first Hunter conference. Robert said to me the other day, he says, look, I can't make it. Could you fill in? I said, sure. Went home, told my wife I'd be on the road. And she said, I'm not quite certain what this Hunter conference is. And I tried to explain it to her. And she goes, I just don't get it. What is this select service hotel? And I said, well, you remember a year ago when I traveled cross country, I had an eye operation, I couldn't fly. And I pulled off to one of the hotels on the side of the road. And I went up, checked in, and had a running nose, threw the tissue into the toilet, flushed the toilet, and the toilet just kind of overflows. So I go downstairs to the front desk, and I said, hey, I got this problem, toilet's overflowing, can you help me? And the guy in the front desk says, yes, I can. Goes into the back room, comes back, gives me a plunger, and says, go fix it, and return the plunger. So that's what select service really means. As far as the bank, Western Alliance Bank, we're a $20 billion bank. We like to say we're a national bank with a regional footprint, and one of our national business lines happens to be hotel franchise financing. As far as the year, coming into the year, we still see strong demand. We see strong deal flow, actually more active than since I've been there. And I've been with the company for 10 years, just returning back, but always connected either as part of management or as a board member. But the deal flow is fairly strong. What we are seeing are some beginnings of some concerns. RevPAR is beginning to slow down a little bit. Construction costs are beginning to rise. The deals need to pencil out better. As a lender, we try not to change our lending standards at any time, so we don't adjust to the markets. We try to stay consistent. And I think what we're going to see, even though we see good deal flow, I think you'll wind up seeing some of the lesser deals begin not to pencil out and maybe to be hibernated for a period of time.
Okay, thank you. We'll probably end up talking a bit about the impact of the tax law change. We may talk a bit about interest rates. Obviously, yesterday, the Fed going up 25 bips and indicating that probably will be a steeper rise to interest rates rising over the next foreseeable period. But I think it was Mark Woodworth on one of his slides talked about the labor market. And, every one of us, our businesses are foundational on the talent. And, what are you seeing in terms of either in your own and managed hotels or in the franchise sector and the bank? How do you see the talent labor market? What are the issues that we're facing? How are we going to, as an industry, how can we work harder together perhaps to solve some of the issues? And of course, Dave, you and I are chairman, vice chairman at the Educational Foundation, so that's my plug, by the way. And there's a number of activities at the AHLA, which I think Dave would be welcome to talk a bit about, that we can also enhance our chances in terms of attracting talent to this industry. But where do you see the issues in the labor specifically? Why don't we start with you, Dave?
Yeah, Kirk, I tell you, we talk a lot about it, you and I at AHLA, but I would tell you it's probably, my number one concern, because the economy's moving along great, job growth, unemployment is like historically low levels. with these tax cuts, if it spurs the economy, it's going to put pressure on wage growth, which will spur inflation. But we need to do something with immigration because, you know, we've got about 30,000 employees, and there's really no pockets of the country that we're not hurting for people. As Kirk mentioned, we've got an AHLA partnered with the federal government. We've got an apprenticeship program going on to attract people, but lots of behind the scenes. If you're not involved in AHLA, I mean, this affects everybody in this room. Whether you're an owner, you're an operator, you're a brand, you're a lender. We need talent at the property level, and it's really if we don't do something about it, I'm concerned that it's going to really become an epidemic and an issue for our country. You're seeing industries already like construction industry, landscaping, farming, agriculture, and they just can't get enough workers, and they're having to turn down business because of lack of talent. So I think it's something that we all really need to wrap our arms around. From a non-governmental agency, we're one of the top employers in the United States.
Yeah, for sure.
Yeah, it's the one thing I hear from our owners. We have, if you look at the number of hotels that are going to get open today, a lot of our owners are worried about where they're going to find associates to run these hotels at all levels. I mean, if you hear some of the stories of what's going on in the Bay Area specifically, you have 2% unemployment in the Bay Area, which means everybody who can work is working, and they're busing people from Central Valley on a daily basis to do, operations. So, I mean, it's a challenge. It's going to be a continued challenge. We need to continue to educate the workforce, why you should, invest in your career in the hospitality business at the college level, at the technical level, whether that's culinary schools or technical schools that can help support us. But it's a growing concern that we hear from our owners on I open 6 hotels. I don't know how I'm going to staff them. I mean, that's a challenge.
Right. It's all hands on deck. I mean, and as an industry, we certainly need to focus on it. I think the AHLA is doing a fabulous job, but I think every person in this room in this industry, really has a responsibility to try to engage on this. I mean, we own properties, we manage properties, we franchise properties. All 3 of those are different challenges for us, but I have to tell you, you can have a great property, you can have the right financing behind it, great location, but if you don't have the right people behind it, it won't succeed. And it is our number one. This is what keeps us up at night, is trying to find the right talent.
I'll just say I'm doing my fair share. 3 of my 4 kids I've put into the industry.
That's great.
So we're doing
Got a boy.
Well, I guess, Ken Green, there's a number of changes going on at Radisson, and I think that's you guys were good, you want to be great. And I think any organization, any company that's in this audience, the company has to be great to attract talent as well. So that's an area of key concern and work.
It absolutely is, and I think we've done a pretty nice job of bringing in great talent into Radisson Hotel Group, and identifying the talent that was already in the organization. It's really a great mix, and if you can set the right culture and get the right, the right people, Again, from a corporate perspective, it's all about having the right strategic plan. It's about having the right systems and processes in place, measuring the right things from a metric perspective, having the right marketing programs. But it all fails if you don't have not only talent, but talent that works well together cross-functionally. It's really so important, and that's the culture. And that's what we're trying to do at Radisson. It's been a nice ride over the last 8 months to do that. So.
I think if Liam were sitting here today, so you guys can help me out, so let him know that I do pay attention at his staff meetings around associate engagement and making sure we're providing great culture and great places for people to work. And I think as part of our integration of the SPG brands into Marriott, that's been a big focus about how do we transform all of those SPGs and bring them into the culture of Marriott, and how do we just continue to enhance what we offer associates to come and work within the Marriott brands, whether it's managed or franchised. How do we think about in that associate engagement culture and such, just to continue? We're only as good as our associates are. That's our capital right there.
Yeah, I guess what I'm hearing from the 3 of you, and Ken the banker we'll hear from in a moment, is in order to be successful, you really do have to be the employer of choice. And so that really puts an onus on you as a leader to to create an environment where people want to come and work and they want to engage, back to your engagement. But Ken the banker, as we like to refer to the two Kens.
So, you know, in bank, everyone always talks about financial capital, but human capital is the most important thing. At 6 p.m. every night or 7 p.m., all our capital walks out the door, and I'm really hopeful they all show up the next morning. And in order to have them show up, there's a level of engagement they need. There's a level of empowerment they need. They need to feel that they're, with us, they're in an entrepreneurial bank, all right? And along with that, then there's got to be the compensation, all right? And that's fairly important. You know, we have a salary program bonus. We have incentive compensation that anyone could be eligible for. And then there's our equity, which helps them grow, has their financial net worth grow along with the success of the company. But more importantly for us at Western Alliance is the access to management. We are a very, very flat organization, and anyone can come in and talk to me about any deal at any time, as well as talk to our senior credit officers or our CFO. And that engagement, being able to walk in to talk about a deal, to get direct feedback, is incredibly important. And for our folks that are out there lending to everyone out in the audience, you know, I always say we get to yes quickly and we get to no even quicker. And the reason we're able to do that is because of the level of engagement and the way people interact within a flat organization.
Yeah, that's good advice. So I mentioned labor, I before mentioned tax law change and interest rates rising. So let's look at those two as factors. Again, some headwinds in our industry. What is some advice for the owners in this audience, for the people in this audience, with respect to what the impact of tax law changes might be on their business, and also in rising interest rates?
So I think we haven't yet seen the impact of the tax law changes. Let's remember it just got approved the last couple of days of 2017, and we're only 3 months into it, and people are still trying to think through what the impact is going to be. Plus, a lot of the regulations haven't been pushed out yet, so owners and operators still don't know what that means. So I think what you'll see is a later on effect of the tax law changes and the investment that's going to come from that. So for me, I see that happening towards the end of 2018 and also driving a stronger 2019. Now, on the interest rate side, the Fed moved yesterday 25 bips. They're probably going to move another 50 basis points for the rest of the year, and there's a couple more rate rises scheduled in 2019, which is a sign of a great growing market with low unemployment, a higher participation rate, GDP around 3%, and all that adds fuel to the fire of an economy that was beginning to grow as we entered the year. So all that looks very, very positive. I think what's going to happen, the rates are going to rise, and that's, you know, for the industry, that's going to put a little pressure on your returns, and it's going to force equity in the hotel lodging space to compete with equity returns in other asset classes.
One of the things I'd like to just maybe note too, one of the tax law changes is the acceleration of depreciation, which if you kind of read through in some of the articles, our industry obviously can take advantage of that, right? And so actually getting owners to kind of think about renovations early, take advantage of this over the next couple of years to take advantage of the accelerated depreciation on their FF&E and things. So
Yeah, good point.
certainly an
And things are only
opportunity.
getting more expensive anyway.
That's correct.
Right.
That's right.
Any comments, any thoughts you have, Cam?
Well, you know, I think what we may see, and to that point, as the tax law gets, more, it gets approved, more implemented, you see the accelerated depreciation. I think it actually spurs potential more transactions ultimately. Yep. So if you're accelerating depreciation, there's, I think there'll be a point in time here in the not too distant future where we'll see an increase in transactions happening, and that's something to be aware of and be looking at.
Okay, so we have some headwinds around interest rates, labor, rising costs of materials, which can slow down some of our new supply adds, perhaps. Tax law, we're not sure. It could be positive, could be negative. There's always two sides to that story. Dave, what are some of the opportunities, though? What are some of the tailwinds that you see in 2018 that people should be leveraging and harnessing?
I agree with Ken. I think we haven't even begun to see the impact of the tax cuts, and I think it's going to have a big impact on demand. And so from a tailwind standpoint, the economy right now, if you look at the balance sheets of Fortune 500 companies, it's very different. I think the rate increases are good because I'm an economics major, and God forbid we do get a blip in the economy. It'd be nice to have a couple levers to pull, and right now interest rates have been near zero
Nowhere
for
to
a
go.
long,
Yeah.
unprecedented amount of time. And I believe most of the stock market analysts have baked in the 25 bips this year and a couple next year. But I also think with debt rising, I think it's going to probably curtail, as you said, some of the projects that are kind of on the bubble, which I don't think is necessarily. Eric doesn't want to hear that.
No.
Ken doesn't want to hear that.
I do.
But I think a little softening of new supply, especially in some of the markets that are, like Houston and Dallas and Nashville and Austin. We just got a lot of rooms coming online. So I actually think you can call that a headwind or a tailwind depending on what chair you sit in.
Right.
But I actually think we'll see a slowing of new development in late 18 into 19, and not from historical levels, but we've been pretty high the last couple of years.
Yeah, I mean, I'm actually surprised at the first quarter we're having in terms of folks lining up to add even more supply to what's already there.
Well, you got plenty of brands to.
You need a couple
Well, it's
more
true.
brands.
It's true.
I
But
wish-
we came off a record year last year. After it's the longest development cycle I've seen now. I'm in my fourth one, right? And this one you usually see 3 or 4 years and then about a 40% drop, right? We're now like in our 7th year, and we're starting to look around and say, how many. Can we get a 5th Street corner?
Right.
We're really starting to. A lot of our owners, I met with some this morning. They're like, I just can't find a place to do another project right now. So, I mean, it's pushing, but we're somehow everybody's finding ways to get deals done.
I guess you'll add another brand then.
I won't comment who has, but yeah, maybe they saw an opportunity.
Ken, you wanted to say something.
Yeah, I was going to say, while the 3 rate cuts are baked in, I don't think the growth is fully baked in. And I think you're going to see a lot stronger growth as we go through the year. And everyone talks about the tax cuts. I think equally as important is the vision out of Washington of less regulation, and the deregulated environment is incredibly important. I think that is unleashing, at least from the banking industry, a lot more lending. And then also the curtailing of the CFPB. So those regulatory pullbacks are making it a pro-business environment. And I think that, along with increased lending in the overall industry, is going to help push the growth rates up. And that's why I think the rate increases are baked in, but I don't think all the growth is baked in.
I agree.
Well, and you mentioned, Dave, earlier the infrastructure spending. If we can get that unlocked, that will certainly help be a additive factor to that growth curve. So as we're looking forward to 2018. As we look back to 2017, I'm just curious if there was anything in 17 that surprised you that you didn't expect happen, good or bad. And to what extent is that a trend line into 18 that you've had to dial into your 18 thinking?
I'll just say that despite the dysfunction in Washington, despite that our president will pick a fight with just about anyone, a lot of things got done. We talked about the tax code, we talked about deregulation, talk about a Supreme Court justice, we talk about more justices added to the appellate court, pullback of the CFPB. I don't think I would have predicted all the fighting and all those benefits to be combined together and still see an economy that's pushing forward.
Yeah.
In fact, everyone talks about the 10-year hitting 3% or 3.25%. I would tell you, if you went back 12 months, 18 months, and if someone said to you that the 10-year bond will hit 3.25%, but you're going to have great growth and tax reform and deregulation, you'd sign up for that all day long. And I think that's probably the thing that surprised me the most.
Yeah. Any of the other guys?
Probably Marriott's acquisition of Starwood.
Yeah.
Didn't see that one coming.
Yeah. I don't think ISG did either.
Yeah.
And Eric, any learnings from the acquisition and integration?
I mean, there's a lot of great stuff going on right now. A lot of heavy lifting. I will self-admit I'm glad I'm not in operations this year. I think last year was a big learn for us, just trying to understand the technical side of how Starwood was built and the technology and the platforms, and how we're going to try to figure out to push those together. We'll start to see some of the benefit of that work, and that it really towards the second half of this year, with a lot of expected, I'll call it the big integration kind of platforms start to happen for us. And so I think at the beginning at the end of 18, early 19, you'll start to see much more of a consolidated, voice in terms of as we market to our consumers through a consolidated platform around rewards and one reservation system and those kinds of things. I have to give praise to the ops team and think that we're 18 months into this, and we're really, the big lifting is the second half of this year, but I think 19 will the work that's been done over the last 18 months will set us up well for 19.
Good, good.
Pretty good.
And Ken, 17 changed your life with a new role, a new responsibility, a new company, new name now.
Sure.
So how's all that playing out for you?
It's, you know what, it's, as I said earlier, it's been a fabulous 8-month ride. When H&A acquired Carlson, I actually raised my hand. I spent a piece of my career out in Asia. Know what H&A is and what they can be, despite what you hear out in the press. I think they'll be very much focused on the travel industry moving forward, and that's a big beneficiary for us. But standalone of that, we have a wonderful strategic plan that is well funded with a great group of people. And we think actually, and I'm going to make this statement, and it's probably be very controversial, Eric, but I think Radisson Hotel Group probably is sitting in a pretty good position right now with all the consolidation that's been going on in the industry. I hear a lot of this narrative about, you can have many, many different brands. It doesn't really matter. The Coca-Colas of the world have many, many different brands, but that's different. We're not a consumable product, and those consumable products, Coca-Cola has one distributor in every market that distributes multiple brands. Our distribution channel in the hotel business is the hotel owner. And so, I don't think it's a fair comparison when you start to talk about that. Our strategy, and which is exciting for us, and I don't mean to give us a little billboard here, but our strategy is really not very innovative. We're going back to the roots of hospitality. We're going back 30 years, back to the success of all these great hotel companies when they had one brand in each segment. And they built their business on the backs of owners that were investing their capital into the vision of the brand. Those owners had a voice at the table, and they weren't competing with other brands in their segment under that same company. Now, somehow that pendulum went from an owner focus all the way to a consumer focus, and that's where we're at today. We think there's a sweet middle. We got to focus both on the owner as our distributor, and we need to protect that return on investment for them. We have to look at the consumers at the same time. That's a neat spot for us to be. We may be a smaller player, but it's a neat place to be.
Yeah, I would tell you I don't disagree with you. I mean, we spend a lot of time at Marriott. I think we've been given credit for how we approach, whether it's growth or impact and approach to that. We say very clearly, and if Liam, I'll quote Liam, like, you're going to invest with people you trust that are going to care for your money and your investment. If not, you'll take your money elsewhere. So as much as we spend on the consumer side in our company, we spend as much time focused on ensuring that we grow well, thoughtfully, assessing impact on every single deal we do. But there's big, big growth opportunities, and there are multiple consumers in this world. And that's I guess, back in the day when we had 1, 2 brands, 3 brands, and we really kind of North America focused. But today, when you look across the world, just like in the food world, there's different tastes, and people are willing to spend different types of dollars based on that experience. So to meet them based on their travel experience or need or want, their thickness of wallet, that's what we're trying to achieve from a global platform. But I don't disagree with you. We have to make sure that we keep both models in check. Yeah. Absolutely.
Great. Dave, switching focus a little bit to management companies. What's your advice to owners out here about picking a management company? Of course, Aimbridge, number one.
Yeah, of course.
Yeah. But what are the types of things people should be aware of, and how would they prioritize their evaluation, if you will, in selecting a good management company?
There's a lot of irony in the world. You and I were Trammell Crow guys, Kirk, together when we were young guys. We started Wyndham together, and I couldn't stand franchisees. You know, whereas nobody could operate our brand better than us, right? And so, you know, life is kind of crazy, but, you know, I've been at Aimbridge for 15 years now. We started about 15 years ago, and we're always learning. But I think the industry, as things have consolidated on the brand side, owners have become larger. I think we're seeing the same thing in the management company world. Some of the larger owners, you know, we manage for Blackstone, Goldman Sachs, Starwood Capital, lots of great owners. We have smaller owners as well, but more and more, I think they're looking for things like SOC 1 compliance, you know, operating system, reporting systems. We manage for public and private REITs. So you know, the management companies of the 80s and 90s weren't as sophisticated. You're always going to have owner-operators, and I actually think it's very, very healthy for our industry to have that. They're great partners of you guys in what you do. But I think what we're seeing is technology is a big must, and the infrastructure to do that, whether it's revenue management, whether, as I said, it's financial reporting, et cetera, you know, business intelligence. We've got a business analytics group with 10 FTEs. You know, 10 years ago, I don't think anybody had a business analytics group, but, you know, we've got big, great data. We have an owners advisory council. We had a meeting about a month ago and asked them a question that was interesting. We said, hey, what is nobody doing in our world that could help you? And the things that came out of it was benchmarking, data, you know, and Dave, you're in a position to tell us with what you operate, you know, over 300 Marriott products, over 120 Hilton products, you know, best of class operating systems. You know, you operate 25 embassies. Tell us, you know, kind of what the best of class is in operating an embassy. And so, you know, we took a lot of good feedback from that. And we're really, actually, I'll be in next week with my senior management team, Aimbridge 2.0, to really look at every part of our business and take that feedback we got and say, hey, where do we need to take this organization, you know, in the next 1, 2, 3, 4 years? The other thing that's great from our standpoint is we get the advantage to working with and learning from all the brands. I always say we're in the catbird seat in that we're the best consultant that money can buy. Not that anybody ever pays us for advice, but the reality is we get to see what Marriott's doing. We get to see what Hyatt's doing, Hilton. I can't say Carlson, Radisson, right, Ken?
Yes, please.
It's taken me a while.
Yeah, you got to get rid of that Carlson name.
You know, IHG, but we get a great opportunity to interact with all these guys, whether it's technology, whether it's revenue management, whether it's you know, development expertise, and that's great learning for us as well.
Great, great. Ken, from the bank's perspective, thinking about, we talked about limited service or select service segment, but there are multiple segments across the hotel categories. How does the bank think about limited service, select service as something you want to lend behind, or do you have a perspective across all segmentation or all segments of the hotel industry? How do you
No, we like the limited and select service area. The margins are very, very healthy there. I love looking at P&Ls that have, you know, 32 to 42% margins at the NOI level, which makes me feel comfortable that, you know, we put our money out, I want it back.
Yeah.
You know?
Usually a good thing.
Yeah, usually a good thing, and it's also a way that you can stay CEO for a longer period of time too, I noticed. So we like that segment. For us, we look at good sponsorship, good operators. We like to be in the primary and secondary markets, and that's how we kind of judge and how we lend, and then we look against the, you know, the debt yields, the debt service coverage ratios, and for us, because we feel we're a little later in the cycle, despite all the good news, we just feel we're later in the cycle. So for us, we tend to move our covenants up a little bit more. So if anything gets tripped, it gets tripped early, and we get there early, and we get to help out the sponsor or operator before a real problem occurs. So we like the limited service.
Great, great. Now back to you, Eric, on the Marriott platform with Starwood and 30 brands.
Ish.
Yeah, ish. How do you think about that development strategy for the Americas, and how do you think about, you know, where you're going to put product, and then how do you then go working with this group out here to deliver that for Marriott?
So, specific in the select service development platform, 6 years ago, you know, seeing the opportunity to grab big data start to really scrape information around how our consumers are traveling. We have Visa cards and American Express cards, so we can actually track how people are spending their dollars and which brands and those kinds of things. We actually partnered with a third-party data analytics company who wasn't in the hotel business, which I think is good, to say, hey, help us to identify where are the unmet demand markets. How do we throw in 200,000 pieces of information and data, run 1,000 different algorithms and some filters to identify where would be the best place, because it only gets more complicated. I have 10 select service brands to try to, which is the best one to lead with, right? But from a consumer perspective, as well as your investor. So if we get a site, right, is it a Courtyard? Is it a Residence Inn? Is it an Element? Today, because of the use of data analytics and data and bringing it all together, filtering it through by customer segment, by business profile, we can actually target very specifically which part of Greater Atlanta we'd like to have a Fairfield, which part of Greater Atlanta we'd like to have an Element, where we might lead with a Courtyard or an Aloft. We have gotten, I think, ahead of the game in terms of taking advantage of the data we have available to us, both on the consumer side as well as the industry side, mushing it together to hopefully, not only just build the right hotels at the right location, but also stave off a little bit of the potential impact or cannibalization issues that our owners feel. So it helps us to make sure that we don't oversize a hotel in a market that will really cause an oversupply in a market if we do it one piece at a time. So we've actually taken some big strides to kind of get ahead of, take advantage of the data that's available to us to make sure we're building the right brand at the right location with the right number of rooms. I mean, that's been part of our goal.
So you've evolved a lot from the days of when Courtyard was announced, because I remember the strategy from Marriott when Courtyard was announced was put it next to a Holiday Inn.
Correct.
So you had a lot of markets to go for.
Yeah, I mean, it is, and again, increasingly more complicated with 10 brands in my portfolio.
That's because you did such a great job, Kurt.
There we go. Thank you for that plug.
That's right.
It was actually a good strategy, though, wasn't it?
Yeah. And Holiday Inn responded accordingly.
Well, if you were smart like me, you started at Holiday and then you went to Hilton, right? And then you just followed that, and then you went to Marriott and you followed that. So yeah, we made a career of kind of making sure we picked the right locations.
Ken, you talked a lot about moving that pendulum back to balance between the consumer, the guest, and the owner. So you've been talking to a lot of owners.
Sure.
What's on their minds? What's their top of mind concern? What are they telling you about?
Yeah, no, I think a lot of it is relationship and the consolidation in the industry, and the attention that they get on a day-to-day basis. That's our the conversations that's our opportunity, right? For our company is listen. We just changed the company to Radisson Hotel Group. Carlson didn't have any awareness. Radisson does. We have this great network of Radisson Blues throughout the world. We only have 3 in this part of the world. So to be able to leverage the Radisson name is really important. So I think that's resonated with owners. But for the owners that we're talking to, they're concerned about, as they make a decision on what brand they're going to either develop or in a conversion perspective, how they're splitting the res system up. And we can't compete with Marriott in terms of that distribution pie. Their pie is your pie is huge from a consumer perspective, but it is being cut up 34 different ways. And ours is very simple. One brand in every segment. Our pie is smaller, but we're only cutting that pie up in 5 ways. And so we really believe, and I think that's what's resonating with owners. We're trying to address their concern on the distribution side, is that when they do a Blue or Country Inn & Suites or Radisson or Park Inn, Radisson Red, their piece of the pie, they get 1/5 of that pie in their market. And as all the things that we're doing to grow that pie from a distribution technology, again, we're pretty simple. We're a closed ecosystem from a technology perspective. We can actually do things. We haven't grown through acquisitions and piecemeal technology together. We can actually leapfrog. And so that's exciting. So as we grow that pie, hopefully an owner's piece of that pie grows proportionally. I think that goes right to their concerns. And I think they want a voice at the table. I'll tell one quick example. When I came on board with Radisson, we're in Country Inn & Suites. We're on Gen 1. We started with Gen 1. We're on Gen 4 right now. When I came on board, we had like 35 Gen 1s, originally Gen 1s built as economy product. We're in the upper mid-scale now. Everybody told me that they could not get to Gen 4. our plan was to get rid of them. Jeff Rohr, one of our great owners up in the Minneapolis area, he took a Gen 1 to Gen 4. I said, well, let me go see that. And so we learned a ton from one of our franchise owners. And we actually believe that we can get these Gen 1s now to Gen 4s because of what a franchisee was doing. Not only that, we've taken some ideas from that exercise that he's done, and we're building that into our Gen 4 prototype for future development. So I think owners want to be close to the brand and help evolve the brands. I think that's a great opportunity for us as a brand owners to be, a lot of the issues are out in the field, so are the answers.
Well, and congratulations, you named all 5 of your brands.
Thank you.
Okay? I don't think we have time left to Marriott.
I tried to do it.
Dave, you're in the management platform. You're sitting there with an owner, and they're selecting a brand. How do you help them go through that list of, Marriott versus Radisson versus others?
We always offer Marriott and Radisson first.
Yeah.
No, it's we do a lot of what Eric was talking about before. I think it's one of the advantages we have is you talk to an owner, we're kind of we're free agent, right? We're trying to do what's in the best interest of the owner. Typically, Marriott's a tough choice because they already have every brand on every street corner in the market, but that's Eric's biggest problem. The reality is we do a full feasibility and analysis, market analysis. We reach out to the brands. Obviously, we're great brand partners and see what's available, get some interaction from them, run comp sets, and really go back to the owner with a suggestion of, how many keys, cost per square foot, what brand, see what we can do to leverage the brand. I will say it's great when you have a couple of options. If you've only got one option, you don't have a lot of leverage. So we're really working on behalf of the owner. About half the assets we manage, we have an equity investment as well. So we like to say that we're side by side with the owner, not just an operator, which is good. But the reality is we're just doing what's ever in the best interest of the profitability of the hotel.
Yeah.
Okay, great. And our banker friend Ken, as you think about the financing outlook for hotels, and we've heard now about, and you've cited the importance of the sponsor of the project, the returns, the brands, the management. Is there anything else that we need to be as an industry thinking about as we work together, or as these gentlemen lead their companies, that would make us more attractive than another sector or another asset class?
So I must have gone to 6 or 7 banking conferences recently, and across the industry, the biggest concern for bankers is the rising cost of deposits. What's your deposit beta, they say. And as those costs of deposits continue to rise, and I think they're going to rise now at a faster clip than what they previously. If you look at your own checking account or money market, they stayed relatively flat through the first couple of rate rises, and now I think you're going to see deposit costs rising. That cost of liquidity is going to cost the banks more. And so as a banker, what do? You're really into the capital allocation game and risk reward. Where do you get the best return for your capital? And I think that's going to put pressure on some of the lending in the hotel group and across all the other product lines that banks have as well, on that risk reward return with the rising costs. So, we've talked about all the rising costs that can happen inside of the hotel lodging space. This is another rising cost. So you see it in terms of, the rate rises, but I think bankers are going to be a little bit more circumspect with how they lend out their money to ensure that risk return, that capital reward is going to be appropriate.
Okay, great. We haven't really, we may have mentioned it, but we haven't really talked about consolidation, and certainly mentioned the Marriott Starwood consolidation, and certainly the management company platforms have been buying other management company businesses as well. Where do we see the outlook for 18-19 for, quote, M&A or consolidation?
I think it's going to continue. I think that Marriott's kind of leading the way. I'll compliment Marriott. They continue to go back with additional leverage to the OTAs, and us as owners and operators are very appreciative, Eric. The one that a lot of people don't follow, it's more in the full service hotel world, but these group group business intermediaries. Marriott issued a statement, I think, Eric, 6-8 weeks ago that said, you know, the Helms Briscoes and Conference Directs of the world, that you're talking about hundreds of millions of dollars that are leaking off our balance sheets to those folks who really do not provide much of a service. And Marriott cut that from 10 to 7, and we're hearing rumblings that some competitors are going to do the same thing. I highly encourage them to do that. But the reality is that I think they're showing, and additionally what I mentioned before about Aimbridge is, you know, the advantages of scale. Kirk, probably the number one thing that I've learned is talent. You know, when we were a small company, you'd hire a young general manager, and he or she would do a great job for 2 or 3 years, and they'd raise their hand, and they'd say, hey, I'm ready for a bigger hotel.
Right.
And you have nothing to give them. The only way they can grow their career is to leave your company. Right. And it's really is not good. As we've gotten larger, I think we had 54 GM openings last year, mainly due to growth, and we filled 50 internally. I mean, that's really unheard of. But we have opportunity as we get bigger to offer really talented people, you know, great opportunities. So I see it, you know, I don't think it's going to be a rash of M&A, but I really continue to think that we're going to continue to see consolidations of really all three of the parts. You know, Host was always the biggest REIT, but now you've got Park, so you've got two that are pretty large, and I think the REITs will continue to grow.
And we saw Felcor RLJ come together, right?
Yeah. And I think we'll continue to see that because there's just advantages
more
of
on that
scale.
side.
Yeah.
Yeah, I would also say whether it's consolidation or M&A, if you'd have said 2 years ago we were going to be, you know, joint venturing with Alibaba, right? So when you think about M&A, digital platforms, you think about some of the other things that have happened, whether it's home share networks and things like that, that some of the brands are getting involved in and those kinds of things. I don't think it's going to be straight just traditional, you know, one brand company buying another brand company. It's investment and add-on M&A that we'll continue to see. So again, I think, you know, for us to, back to your about pie size, our goal is about growing the pie and how do we make it even bigger for all of our owners. Doing a joint venture with Alibaba and getting in to start to, you know, create a relationship with their users and open up the world of opportunity to travel with us when they continue to start to think about leaving China and such. That's a huge opportunity. I think you're going to see more of those kinds of things in addition to potential other consolidation of what we call traditional consolidation.
Okay. And I don't know if the changes at Radisson are going to put a big for sale sign on the company or not, but
No, absolutely not. Actually, we like the position that we're in. You know, I did my little soapbox and billboard, and I apologize for that. But no, we like where we're at, and I think we'll look out 10 years down the road and say it was one of the great growth stories. And it's in large part because of, you know, companies like Aimbridge and who, you know, manage some of our great properties. I have to tell you, what Dave has done in that organization is I'm plugging you now, Dave, but, you know, really, when you talk about taking 50 internal hires and as GMs for 54 open spots, I mean, that's fabulous, and that's a lesson learned for everybody in this audience is to sort of look at what you do. It's fabulous.
well, Ken, you spoke well for the company, and certainly this audience wants to hear what you're doing at Radisson. It's all new. Every week there's another new announcement of some
Stay
kind.
tuned.
So we're staying tuned. We have just a few minutes left, and I want to just close with one question. Happens to be Bob Hunter's favorite question, I think, which is what keeps you up at night? And for me at my age, you can imagine it might be a physical issue. But yeah, I'll start with you.
So I think two things. One is complacency. The market's been good. The fundamental economy's been good. We'll kind of see it moving forward to be stronger. People tend to get complacent, and with complacency comes mistakes. Second thing is, you know, success is never final, and I think a lot of people think of it. We hit a number, we hit a target, we're done. What success gets you is more hard work to get more success, and those two things are important. That's what I kind of bring every day to the job and tell our folks.
That's great. You want to take it, Dave?
Yeah, I think I'll go back and get on my soapbox, Kirk. I mean, I think as it relates to the industry, I have 3 daughters, so that's what keeps me up at night, you know. But from a business perspective, I'd go back to the availability of talent from an hourly position all the way up through. And I know you're well aware of some of the great things we're doing at HNLA. But you know, if the economy does heat up like we're saying, and we see, you know, these tailwinds that we've discussed for the last 45 minutes, I continue to see this pressure on wages and, you know, non-availability of talent to fill our hotels. And I just think it could become an epidemic if we don't kind of collectively, and if we can get the guys in Washington, the guys and gals to get together on this, because I see it as being a real, could be a crisis for us.
Yeah.
You know?
Well, and I want to take a moment to commend you for your leadership at the Educational Foundation with AHLA, because you're putting your money and more so your time and your talent where your mouth is, Dave.
Thanks, Kurt.
You know, I know you're a busy guy and you're trying to build a platform and continue to get bigger, and it takes a lot of time out of your day to focus in on these other issues. So I appreciate that, and it's good
You
to be your
raised
partner.
$8 million for us, so thank you.
Well, they
Kurt
gave
raised
$8
all the
million.
money, I get to spend it.
I just asked.
Yeah, no, you did a hell of a job.
Yeah, well, thank you. Eric.
It's what's on the owners' minds today, and that's construction, labor costs, time to get their projects from start to finish just increasingly continues to stretch, which, you know, time is money for all of them. And then labor. Labor across the industry is a big, big issue for us. It's great to put a nice pipeline of hotels, but if we can't, at the end of the day, fill them with great associates that are well-trained and committed to the brands and the company, it's going to be a challenge for us to deliver on the expectations. So labor is the big one.
And Ken?
Well, you know, we just transformed our organization, and so what keeps me up at night is the number of people, talent that have joined our organization. They bought into the vision, the number of owners that we've had that are also buying into the vision. And we're in execution phase now, so what keeps me up at night right now is making sure that we deliver, and you know, I get out and tell the new story as fast as we possibly can. And it's you know, we got a good story to tell, but we got to get out there.
Yeah, you can't talk your way out of something you've acted your way into.
That's right.
So,
Thank you.
Well, everyone, let's give this great panel a round of applause. Thank you for your participation. Thank you for attending.